This meeting is being recorded.
All right, welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to have all of you with us today as we explore a couple of different concepts of cash, fraud, and internal controls. Before we jump into today's lecture, I just want to quickly call your attention as to where we are in the classroom. We are halfway through the completion of this course. We are in week 8 out of a 16-week course. So, as you might suspect, and you probably have this situation going on in your other courses, we are in the midterm week. Okay? So, here's what we're going to do today. We're going to cover the cash, fraud, and internal control lecture. I'll remind you of what you have to do. This week we have another fun, exciting LinkedIn Learning certificate. This one's on Excel. Excel is an extremely important tool for you to use as a professional. Excel is required by pretty much every single business on the planet. And I'm very confident that whatever management role you end up in, assuming that you're not a manager already, Excel is going to be a critical thing for you to know. And in accounting, we use Excel all the time, whether it be for budget, developing a budget, or using it for the development of our financial statements, etc. We use Excel. So I really feel that this LinkedIn Learning Certificate is going to be critical for your professional development in the future. And therefore, I'd love for you to complete this LinkedIn Learning Certificate called Excel for Accountants, which will be your Engage and Explore activity for this week. And of course, I also want you to post it on your LinkedIn profile because, as you might suspect, employers love the skill of Excel. You know how to use Excel? That's going to be huge. And you can demonstrate you know how to use Excel through the certificate. So we have the certificate to complete for this week. We have the related quiz for Chapter 8 related to cash, fraud, and internal controls. And then, in addition to those two things, we have the midterm exam. So 3 action items for you to complete for this very busy week. The LinkedIn Learning Certificate for Excel, the Chapter 8 quiz, and the midterm exam. These are the 3 things we need to complete for this week. Related to the discussion, we'll talk about the cash, fraud, and internal controls, which is Chapter 8. Once we're done with that conversation, I'll talk about the midterm exam. So let's do it in that order. My recommendation for success for this week is to start very early. Some of you have already done these 3 things. Awesome. Cool. There's nothing wrong with working ahead. If you haven't started the LinkedIn Learning Certificate, I would love for you to do that like tonight, tomorrow, soon. Yeah, soon. Then do the quiz. And then once these 2 things are done, move on to midterm exam. I'm going to give you some tips for the midterm exam after the lecture. So that's where we are. Let's jump into the lecture, cash, fraud, and internal control. And after the lecture, we'll talk very briefly about the midterm exam. Okay, so as you know, in accounting, we have both accrual-based accounting and cash-based accounting systems. Regardless of the system that your business is using, there is a high probability that you will use cash at some point for pretty much anything. Cash is king, as they say. And in business, that is extremely true. We use cash for pretty much everything. And not just cash, but also checks and also vouchers that are just like cash. So let's talk about how we control cash. Let's talk about the potential for fraud and all of the necessary controls. So that's what we're going to talk about in today's discussion, today's lecture. So first, I want you to understand the importance of protecting your assets. So critical you protect your assets. And not just your business assets, but also your personal assets. Right? We got to make sure that everything's safe, secure. Right? How do we do that? We got to insure it. Right? Like think about your home, think about your car, think about your other fixed assets, machinery, or whatever. How you protect them things. We protect them through insurance. And we insure those. What that means is something happens to that asset, well, yeah, we're going to be upset about it. But I tell you, the insurance company is going to take care of us because it's insured. We're protecting it. In addition to those protections, on the business side of things, it's important that we control our assets. We control them. Now, how do we control our assets? We create what's called and use what's called an internal control system or system of internal controls. The idea here is that we are monitoring and controlling our business activities as they occur. The first part of an internal control system is to use policies and procedures to protect our assets. How do we protect our assets? We have insurance on our assets. Other ways we protect our assets is we secure them. How do we secure them? We lock them up. Just the same way that you lock your front door, you want to be able to lock up your inventory. Okay, you got to secure your inventory. Protect your assets, right? So really important we protect our assets. We also need to ensure reliable accounting. What this means is that we audit our accounting practice to make sure that our financial statements are true and accurate. True and accurate. How do we do that? We have internal and external audits of our financial statements. What that means is I got somebody who works inside the business, an internal person who reviews and verifies and validates the transactions that have occurred throughout the year and says, yes, to the best of my ability and knowledge, these are true and accurate. Therefore, the accounting system is reliable. Okay. We also have what we call external auditors. These are people outside the company that the company hires to come in and verify that the accounting information is true and accurate through the same process of auditing it. Both of these actions ensure that our accounting system is reliable and true. The third part of an internal control system, of course, is to uphold company policies. Policies and procedures are in a place for a reason. Okay, that we don't just create policies and procedures to give us something to do. We use internal company policies and procedures to govern the operation of the business. And this governance allows us to operate effectively. Okay, it's part of an internal control system. And of course, the last part of a good internal control system through policies and procedures is to promote efficient operations. The idea here is that the more efficient we are, the less waste there will be in the company, and that we can continue forward in our operation. That's internal controls. I had mentioned this idea of the internal and external auditors. Every business should have internal auditor, and every publicly traded company is required by law to have an external auditor. Every publicly traded company is required by law to have an external auditor. For private companies, it's strongly recommended. For publicly traded companies, it is required by law to have an external auditor. And the law that governs this is called the Sarbanes-Oxley Act of 2002. Sarbanes-Oxley, which are two Congress people, who I believe have since retired and passed. These two Congress people established the Sarbanes-Oxley Act, which says that publicly traded companies must be audited, and that these companies must have effective internal controls. The auditors evaluate those internal controls, and it also provides some oversight through the Public Company Accounting Oversight Board, and it also says that the potential punishment for those who violate this act. Now, I'm going to tell you a very quick story, a history story. For those of you who may be old enough to remember, or for those of you who may have heard about this case, back in the 1990s, there was a company, and this company was called Enron. It was a company in Texas that was an energy provider, if you will, of sorts. And they were publicly traded, this energy company, and they would, if they're publicly traded, so people would buy shares of stock in the company and sell shares in stock in the company. So a couple of years in the 90s, they had some pretty bad years. Their sales were down. They just, weren't getting enough business. And so a couple of salespeople decided to create some fake invoices, make it look like the company's got more sales than they actually had. Okay, that's against the law, by the way, to do that. So they decided, hey, let's cook the books. Let's make it look like we got a bunch of sales, we're doing real well, and that'll attract new investors. Think about it. Nobody wants to invest in a failing business or a business that's not doing well. I'm not going to purchase shares of stock in a failing business. It's like when we talked about Sears. Remember Sears? It's like nobody's buying shares of stock in Sears when they're going down. It's like, no, people don't buy into failing businesses. So that was the case with Enron. And so to make it look like the company's doing well, they create all these fake invoices, fake sales, and they'd void them out and reissue and void them out. Highly illegal stuff. They're making it look like the company's doing better than it actually was. And so the case with Enron is that in the early 2000s, they discovered these irregularities. Someone internally discovered the irregularities in the accounting practice with the fake invoices, and they blew the whistle to the federal regulators and said, hey, hey, SEC, Securities Exchange Commission, this is what's going on in Enron. They're cooking the books. And so SEC investigates, finds a lot of wrongdoing, and a couple of executives went to prison, for 25 years. A couple of them died in prison. There was also a murder. There was also a suicide. It was a really interesting business case. So what happened in 2002 was Sarbanes-Oxley Act comes about to prevent something like this from happening again. So that's why we have this act. So that's the story. That's the story behind the act. To help businesses in the governance of their internal controls was established the Committee of Sponsoring Organizations, also known as COSO. And what they did is they helped to establish 5 components for a good quality system of internal controls. The first is called the control environment. Just as the name implies, we need to protect the physical assets. And in the control environment, they look at the company structure, ethics, and integrity. The second is the risk assessment. This helps us to identify, analyze, and manage any risk factors. An example of a risk factor would be if you're running a gas station, for example. You can already see a bunch of risks there, right? One risk is that somebody comes and robs the gas station. Another risk is that somebody backs into the gas pump and blows the place up. Another risk is that the customer slips and falls in the front because you forgot to salt the sidewalk in the winter. These are all risks that things like that might happen to the business. Or those are all external risks. The company also has internal risks. And the internal risk is that the employee is doing the one stealing. Okay, that's an internal risk. Another internal risk is misplacement of inventory, perpetual intentional fraud. Right? Those are internal risks. So you have external risk and internal risk. And the idea is that the company needs to do what we call risk assessment. We identify, analyze, and manage all types of risk to prevent these from happening. We do that through a system of internal control activities, which are policies and procedures to reduce the risk of loss. The fourth component is information and communication, where we have reports to both internal and external parties. Internal employees, external, the media, the customers, the government, etc. And the fifth component of the COSO framework is monitoring. This is a review of regular review on the adequacies of our internal control policies and practices. So that's the framework. So we have the framework from COSO. The next thing that the companies need to do, this is best practices, is to establish and use the principles of internal control. So there's 7 principles to follow for each business. One, of course, is to establish the responsibilities of each employee. Who's responsible for what? Second is, of course, to maintain adequate records. Personally, for taxes, you're supposed to, not everyone does this, keep your tax records for at least 7 years. Keep your tax records for at least 7 years. Individually, you're supposed to do this. Why? Because if the IRS sends you a lovely letter in the mail, this happened to me, it says, hey, we reevaluated your 2019 return, and we noticed some irregularities. Okay. And then they send you a bill. If you don't have your tax records from 2019, it's real hard to prove that in a court of law, or at least be able to provide them IRS with copies of evidence that you did indeed pay those taxes. You see what I'm saying? So for you personally, hang on to your tax records for at least 7 years. Okay? For business, 10 years should be the minimum. Okay? So maintain adequate records. You know. And it also includes things like invoices, copies of checks, etc., to match your accounting information system. Number 3, insure assets and bond key employees. Just as the name implies, insurance. Make sure you have adequate insurance on your facilities, on your equipment, etc. The second part is that it says the bond key employees. Here's what that means. Let's say you work in retail. I used to work in retail. And you're a real responsible kind of person. And so let's say you're in management or entry level management or whatever, and they give you a key to the store. Okay, you got a key. That your employer might ask you to sign a document. That document is called a bond. They are bonding you. What that means is that you're being held responsible should anything happen to the store. You're being insured. Okay, you're being bonded. That's what that means. Bond key employees. And this is very common for most businesses for management and above. Separate record keeping from the custody of assets. Here's what that means. The person counting the cash should not be the same person that received it. Okay? The person counting the cash should not be the same person that received it. Here's what I mean by that. Let's say I'm a cashier, okay? Bringing customers up, collecting their cash for the payments, blah, 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 doing my cashier thing. I am receiving the cash from the customers for the payment of goods, right? They're purchasing, I'm at Macy's, I'm the cashier, they're buying stuff from me. All right, ringing them up, taking the cash, ringing them up, taking the cash. I put my cash in the cash drawer. At the end of the night, I'm not counting the cash. I mean, I'm counting my drawer, sure, to make sure that what I have in there matches the register. Then I take that cash, I put it in a bag, and then I put it in the safe. What happens the next morning or later that night? The manager comes in, someone else comes in and verifies that the cash is correct. Okay? Then what happens is that the manager takes the ticket from the register and the cash receipt. They give that ticket to the accounting office. The accounting office records it in the accounting information system. It's a separate custody. See? Record keeping, the tickets are separate from the custody of the assets, the cash. That's what that means. Also related to that is the division of the responsibility for related transactions. The same person counting the cash should not be the same person that received it. Another thing is that the person who's ordering the inventory should not be the same person receiving the inventory. Quick story about that. My days in the hotel business. Okay? The bar manager calls up to the accounting office and says, "Hey, Dr. B, I got to order some liquor, for the bar." Okay, no problem. So the bar manager tells me, the quantity of everything that he needs. Okay, no problem. place the order. I fill out the purchase order, get a bunch of signatures, send the purchase order into the vendor. Okay, that part was me. I made the order. Someone else is going to receive it when the order comes in. Okay, probably the bar manager. Bar manager going to count, verify every bottle that comes in, match it with the packing slip, match it with the purchase order, and then lock that inventory up. Then later someone's going to go verify that the inventory is there. Dividing that responsibility for for a related transaction, you see? Why is that important? Because if the bar manager did everything themselves, a couple bottles might fall off the back of the truck. See what I'm saying? So that's why it's important. Number 6, apply technological controls, obviously. This is like punching in and out in the time clock. That's a part of it, technological controls. The register, technological controls. Security cameras, technological controls, you see. And the 7th one is perform regular independent reviews. Yeah, definitely. You got to audit the drawers independently. Another example of this, the hotel business. Once a month, I would go down to the bar and physically check the weight of each bottle and match it with the sales receipts. Okay, that tells me if there's any misappropriation of the inventory. Okay, so internal controls, be clear, concise, and to the point when it comes to establishing who's responsible for what. This also helps to determine who's at fault. When you set the established responsibilities, you're being clear, concise, to the point, and identifying who's at fault when something goes wrong. Adequate record keeping. The idea here is that we're tracking everything. We're protecting our assets, helping our management, and we're keeping a detailed record of everything that comes in, everything that goes out. We're using the chart of accounts. We're using printed forms, signatures, sales slips, all of those fun things. Okay. Ensuring assets and bond key employees. Making sure we have enough insurance to cover any type of loss that may happen. Making sure that everyone with a key is bonded, insured against any theft from that employee. Separating record keeping from the custody of assets. The same person counting the cash should not be the same person that received it. The person receiving the inventory should not be the same person that ordered it. Okay, separation of duties. Yes, very important. And of course, all the records roll up to the accounting office. Yeah, that's the idea here. Reduces any risk of theft or waste. That's the idea. Related to that, division of responsibilities for related transactions. It's great to have 2 or more individuals doing the same thing. Why? Because one person can check the other one, make sure they ain't doing something funny. Separation of duties. Technological controls, the time clock, security cameras, registers, scanners, etc. All that stuff helps to control the process, the flow of assets. And of course, regular independent reviews. Have the accounting office come down and audit the inventory. Okay? Or someone outside the company, even better, comes and does an audit. You got to make sure that all our assets are there, everything's accounted for, etc. That's what makes a great control system. So all those things work together. Yeah, they all work together. How does it help? It helps to reduce processing errors, definitely. Provides more extensive testing of records, making sure that everything was recorded accurately. The separation of duties. Same person receiving the inventory should not be the same person that ordered it. Person counting the cash should not be the same person that received the cash, etc. Increased e-commerce. Yeah, we see a lot of that happening now as a result of good internal controls. And new evidence of processing. So yeah, these are all things that have evolved from technology and are related to the internal control process. I'm sure you've probably heard about blockchain by now. Blockchain is another technological advancement which is considered to be a very secure type of accounting ledger. The idea here is that the blockchain ledger is continuously and simultaneously updated and verified. It's a technology that makes it very difficult for the ledger to be modified without any detailed record of changes. Okay? It is impossible to destroy any type of transactions in the blockchain. Think of the blockchain as a technological advancement that helps to prevent any type of modification that can't be destroyed, and it helps auditors to focus on the technology that helps to verify the accuracy of the transactions. That's blockchain in a very general sense. It's very separate from something like Bitcoin, very, very different. Yeah. Limitations of internal control. People are not perfect. Okay. Humans make errors. Sometimes we can be careless or misjudge things or be confused. Yeah, people aren't perfect. You know. The other limitation to internal controls is intentional human fraud. Okay, sometimes people look to beat the system, right? To override the system. We do this for a couple different reasons. I'm never encouraging anyone to commit fraud. That is, not only is it illegal, it is unethical, and you can really destroy your life if you commit fraud. But why do people do it? Number one is that there's an opportunity to commit fraud. This comes from a weakness within the business. The opportunity is like finding ways to exploit a code in the cash register. You hit the no sale button, register opens up. That's an opportunity, right? So there's an opportunity to commit the fraud in the first place. The second part of fraud, why people do it, is called pressure. Pressure comes from a couple different places in life. People have financial pressure. Got to pay my bills, you know, oh, this place doesn't pay me enough. Got to pay my bills. Family pressure. Oh, you know, I got a kid on the way. Got to figure out how to pay for the kid, all this stuff. Social, societal stresses. All these pressures in life culminate in our rationalization to commit the fraud in the first place. Okay, so opportunity, pressure, and the last one is rationalization. Employees justify committing fraud. Oh, everyone does it. Oh, it's a normal thing. The business won't notice. That's rationalizing. So opportunity, pressure, and rationalization are the reasons why humans commit fraud in the first place. We call this the fraud triangle. There's, three sides to the fraud story. The last part of this limitation is called a cost-benefit constraint. This is where the cost of the internal controls cannot exceed their benefits. Cost-benefit, right? If the costs exceed the benefit, then it's no longer a benefit, you see. So cost-benefit constraint. Okay, so we talked about internal controls very extensively. Now let's talk about cash. Cash is king. Let's talk about cash. It is critical to have a good system of internal controls that we just talked about to protect your cash and cash equivalents. They really need to meet these three specific guidelines. One is that handling cash is separate from the record keeping of the cash. Remember, the person counting the cash should not be the same person that received the cash, and that the receipts of that cash rolls on up to the accounting office. Cash receipts are promptly deposited into the bank. Yes. Don't leave cash sitting around. Put it in the bank. Cash is very dangerous. Don't just leave it sitting around. Yeah, reminds me of the grandmother that has the cash stashed under the mattress. What happens when the house burns down? Cash gone. Somebody knows the cash is there. Grandma gonna get robbed. Don't leave cash sitting around. Put it in the bank. Please put it in the bank. Okay. The third part of controlling cash is that cash payments are made by check or EFT, also known as electronic funds transfer. Checks are nice and simple. It's paper money, baby. It's got the dollar amount, who is paid to, signature. I love when I get checks. I could get a check in the mail, and I'm cool with that. How do we deposit checks nowadays? I haven't been to a bank branch in, I think, years. Why not? Because, number one, I don't deal with cash really. And number two is, if I get a check, I take my phone out, I go on my mobile app, I take pictures of the check, sign the back of it, take a picture, and upload it to the bank through the app. Nice and easy. Almost every bank does that now. And the other one's called, the other part's called electronic fund transfer. Just as the name implies, I can transfer funds from one account to another electronically through the internet. That's the term EFT is just so old now. But think about it. Right. So that's how to control the cash. Cash, as you know, as the name implies, are things like currency, coins, deposits into bank accounts. That's cash. Cash also includes items such as checks, cashier's checks, certified checks, and money orders. All of those things are considered cash. Cash are as good as cash, right? Checks are the same as cash. Money order, same as cash. See? We also have what's called cash equivalents. Cash equivalents. These are short-term, highly liquid investments that can be quickly converted into cash and are close to the maturity date and not sensitive to changes. Here's what cash equivalents is. A share of stock in a company. Share of stock in a company is a short-term, high liquid investment. I can buy a share of stock today and sell it tomorrow. Okay? That is a cash equivalent. Short-term investment. Okay. Very important to manage your cash. Two parts of the plan. Plan cash receipts to meet cash payments when they are due. Fancy thing for saying make sure you got enough cash in the bank to make your payments on time. That makes sense. Okay. Got enough cash in the bank to make your payments. And the second part of that plan is to keep a minimum level of cash necessary to operate. I would hope that that's common sense, but I know it's not. Okay? Let me explain that one to you. If you're in business for yourself, let's say you have a mobile food truck, all right? You got to make sure you got enough cash in the bank to cover your expenses. Fuel, insurance, inventory, all those important things, yeah? That's number one. Make sure you got enough cash. And pay your bills on time, yeah? License fees, etc. Step two is minimum level of cash necessary to operate. What does that mean? Let's say you got employees. Now the game has changed. If it's not just you in the business, you got employees that you're responsible for. Okay, here's the thing. You must, by law, in most cases, some states are a little weird about it, but in most cases, by law, you must have a separate bank account that is only used for payroll. And in that account, you must have a certain amount of cash in order to ensure that you can have the ability to pay your employees' wages. Okay? That's what that means. Those are the two steps. Effective cash management involves encouraging collection of cash receivables. Receivables. Some of your customers pay on account receivable. That means they're going to pay you later. Okay? Got to make sure that you collect. Don't let the customers be late. Right? Encourage the collection of receivables. The other way, you already know this, the other way to encourage your customer to pay you early, offer them credit terms. 210, not 30. Give you 2% discount if you pay it within the first 10 days. Otherwise, the whole thing is due in 30 days. You remember that, right? Delay payment of liabilities. Well, sometimes if you're low on cash, you might consider paying a bill later too. Oh, I know it's due in 30 days, but here it is in 45. If you can get away with it. I strongly encourage you never to do that, but if you have to, you have to. Keep only necessary assets. Don't hang on to stuff you don't need. All right? That's what that means. Don't hang on to equipment that you're not using. Plan for expenditures. That's fancy term for have a budget. But budget out in advance. Plan for expenditures. And if you have extra cash sitting around, invest it. Help your money make money for you. Invest your cash. So if you follow those basic principles, you'll be all right. Now, we're going to talk about cash receipts and cash payments. First, let's talk about receipts. Sometimes customers pay us over the counter. Remember, we're at Macy's, okay? I'm going to have a bunch of customers come up. I'm going to scan their inventory, perpetual inventory system. I'm going to scan their barcode for the stuff they're buying from me. They're going to pay me right then and there. Cool. All right. They're going to pay me cash. So what happens at the end of the night? At the end of the night, after I've scanned, sold a bunch of inventory to my customers, scan the barcodes, collect the cash, scan the barcode, collect the cash. End of the night, I got to count my drawer. Okay? I started the day with $200. That's my bank in the drawer. I received, over the bank that was already in there, I received $550 in sales. Okay? $550 in sales. That's how much I sold. And so I start counting the cash. The register says I made $550 in sales. Therefore, I should have $550 in cash. So I count the cash, right? Count the cash. I leave the original 200 in the bank or in the drawer. The $550 over that is what I pull out. I put it into my deposit bag. I put the deposit slip in, the cash sheet, right? The deposit slip. Put that into the bag, and then I put it in the safe. So, what happens? That cash and that receipt go to the accounting office. Accounting office got the receipts. They verify what's in there, etc. That's how it works. So, sometimes we make mistakes. Hey, I remember being a cashier. Sometimes I wouldn't give enough change, or sometimes I give too much change. Okay. Or, the bills stick to each other. Yeah, it's life. We make mistakes. So here we go. I told you I made my $550 in sales, right? So I counted my cash drawer, and I had $555 in there. Whoops. Apparently, I forgot to give somebody $5 in change. Whoops. So I have to record that difference. So when I give the 555 in cash up to the accounting office counts it out and say, I got $550 in cash here. I only made $550 in sales. That means I'm over by $5. I debit cash $555 because that's how much cash we actually collected. I credit the $550 in sales because I only made $550 in sales. The $5 is overage. So I credit an account called cash over and short $5. This is an asset account because it's cash, right? I credit when I'm over. I debit when I'm under. Right? So now here we go. I forgot to give that customer, I gave that customer too much change. Okay. I gave them $4 more than I should have, and they took off running. Okay. So what happens? In this case, I made $625 in sales. I counted my cash drawer, and I only had $621. Whoops! I gave somebody too much change. Well, I debit my cash, $621, because that's how much cash I actually have in the drawer. Then I debit my cash over or short. In this case, I'm short by $4. And I credit sales, $625. See how that works? Life happens. What about the mail? Sometimes people will send us checks in the mail. I'm going to say something that I shouldn't have to say, but I'm going to say it. Don't you ever, ever send physical cash in the mail. Please don't do that. Even if it's a birthday card with some cash, don't send cash. Send a check. Please don't send cash in the mail, ever, for any reason. Never, ever, 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 ever send physical cash in the mail. Why? Because something's going to happen to it. Promise you. Don't put physical cash in the mail. Okay. Cash receipts via mail. Two people are assigned to the task of opening the mail, typically. The cashier deposits the cash into the bank, meaning checks. The record keeper records the amount received. Simple. Remember, separation of duties. That's why I got two people. Control of cash payments. It is real important that when you're collecting cash from your customers, from their account receivable, that you record it to the right account. All right. We require all payments to be made by check, especially when receiving it through the mail. But typically, we always require customers to pay by check, especially for their account receivable. This also limits access to accounting records, except for those who have the authority to sign checks. We also need to make sure that our cash budget includes projected cash receipts and payments. I gotta know when I expect to receive cash and when I'm expecting to pay. So that way I can have what's called a cash budget. This helps me to make sure that I always have enough cash on hand for operating the business. We also have what's called a voucher system, typically. The voucher system helps us to verify, approve, and record liabilities for cash payments. And then we issue cash payments verified, approved for those liabilities. Here's what this means. It's like a petty cash fund. Sometimes I'm going to use cash to pay a bill. Why? It's small amount. Yeah, just take care of it. I got to make sure that I track that cash payment through what we call a voucher system. Yep. That's the idea here. This is an example of the voucher system. If I'm sending cash, there's a couple of documents: purchase requisition, purchase order, invoice, receiving report, invoice approval, and then, of course, the check. Yeah, I remember doing this in the accounting office at the hotel all the time. Every time I had to pay a vendor, it involved all these documents just for a simple payment of like $10 or whatever. It didn't matter how much the dollar amount was. I always had all these documents. Why? You got to make sure that you have a paper trail. So when the auditors come in, you can show every single dollar that came in and came out. That's the idea of this voucher system. You're establishing a paper trail. I talked very briefly about petty cash. The idea with petty cash is that we do it for small things like shipping fees, minor repairs, low-cost supplies. If you've ever worked in the hotel business, at the front desk, you might have a petty cash fund. Let's say it's $200, okay? Reason why you got $200 in cash is because you might have a guest come in that took a cab when the hotel has an airport shuttle. In that case, you pay the cab. You need to purchase stamps so the accounting office can send bills out. You need to pay the flower lady who does the lobby, or lobby cleaning service, dry cleaning for guests. Okay, there's a lot of different reasons why petty cash exists, but they're for small amounts for various small things. How do we establish a petty cash fund? We debit petty cash and credit cash. It's an asset account. It's the same as cash because it is cash, but we need to make sure it's in its own account. Yep. That's what petty cash is. And of course, we operate the petty cash fund accordingly. We pay for small things, right? Every day, every couple of days, a little bit of cash here, cash there. So here we have an example of November transactions. I had 4 transactions. I ended up using $71.30 of my petty cash fund. So at the end of each month, I need to reconcile that. And the way I do that is I make an adjusting journal entry in my accounting system, and I debit each expense and I credit cash to show the use of that petty cash fund, right? And then at the end of the month, I'm going to end up making another adjustment to increase the petty cash fund by the amount that I used. So to increase the petty cash fund, I debit petty cash and credit cash. This kind of shows like a reimbursement, right, of that petty cash fund. And if I need to decrease the petty cash fund for whatever reason, I just do the opposite. Debit cash, credit petty cash. You don't understand that. With a petty cash fund, it should not be used for over or shorts. That should be done separately. In some cases, the business might do it that way, which is fine, but I strongly recommend against that. Yeah, this just gives you an idea of how it works. What does a bank do when it comes to cash? A couple different things: checking accounts, savings accounts. They provide deposit tickets, bank statements, electronic funds transfer services, and signature cards. There's a couple things that the bank offers. That's what a deposit ticket looks like. If you're ever in charge of the cash at work, you'll have to fill out one of these tickets. It's the amount of currency, amount of coin, and on the other side is the list of the checks. And then you provide it to the bank. It serves as proof of the deposit. You'll get a copy of that along with a receipt. You bring that back to the accounting office. I shouldn't have to show this, but this is what a check looks like. For those of you who haven't seen one, this is what it looks like. I'm sure you've all seen one at some point, but just in case you haven't. Check includes who made the check, who is being paid to, who the bank is, signature, amount, etc. This is an example of the bank statement. It shows all the cash coming in and out of the bank account for various reasons. Checks coming in and going out, cash coming in, checks going out, etc. And then toward the bottom, you see interest earned. In this case, most bank accounts earn interest on their balance, so that'll be on the bottom of the statement. It's also important that we reconcile our bank account in our accounting information system. And the reason why we do that is to make sure that whatever our balance is in our actual bank account matches what we have in our accounting information system. We've got to make sure that they equal. The reason why they never equal at the end of each month is because a couple of things happened that maybe you were unaware of. On the bank side, deposits in transit need to be added in, minus any outstanding checks that you've written that haven't been cashed yet. That gives you your bank balance. On your book balance side, we got to add in any interest that we received, minus any bank fees or NSF fees, and that'll equal our book balance. Once we go through that reconciliation process, both the bank and the book should be balanced. That's what a bank reconciliation is. And this is the formula for it. Very simple. Cash plus deposits minus outstanding checks plus or minus any bank errors gives us our adjusted cash balance in the bank. And then we balance it with our book side. Cash per the book plus interest and collections minus any fees plus or minus any errors gives us our adjusted cash balance. This is an example of that process, of that the 8-step process. Very, very straightforward. And then these are the type of adjusting entries that we would make along the way for things like the collection of interest, etc. Very, very simple. And of course, any good accounting lecture includes a couple of ratios. So one of my favorite ones is days sales uncollected. Days sales uncollected measures how quickly the company can convert its accounts receivable into cash. How quickly we can convert our accounts receivable into cash. Yep. Very important thing to know because we got to know how quickly our customers are paying us. We take total accounts receivable divided by sales times 365 days. Yep. And lastly, again, very important that we have proper documentation. Got to have a good paper trail. Every time we write a check, we got to make sure that we have a purchase order, purchase order, packing slip, invoice, and then anything else related to that, to attach it all with a copy of the check, get the signatures, then send the check out. Paper trail, gotta have paper trail. Same for the invoices, goes through an approval process. Same for vouchers, goes through an approval process. Again, documentation, very, very critical in accounting. Yeah, just gotta make sure everything matches up with what actually happened. So that is the end of our discussion on cash fraud and internal controls. Any question about cash fraud or internal controls before we quickly discuss the midterm exam? Really? Good? Okay. I trust y'all. Just want to make sure. All right, midterm exam. Let me stop this part of the recording and just quickly start another one.